For this video lecture, we will be talking about accounts receivable management as part of our current asset management. Okay, so AR management refers to the set of policies, procedures, and practices used by the company to manage sales offered on credit. So basically, when we say accounts receivable, this arises from credit or on account sales. Okay, so we extend credit to our customers. This one reason for doing that is to increase the sales. Okay, so it encompasses the evaluation of the client credit worthiness, if they have the history of good credit standing or not. Okay, as well as its associated risks of non-paying or delinquencies. So it also include establishing sales terms, meaning to say uh, the discounts that we will be offering and the credit policies that we will be imposing to our customers. So it also include designing an appropriate receivable collection process or methods so that delinquencies from payment, okay, of the customers will be avoided and minimized. So AR are found on the balance sheet. Okay, this is part of our current assets section. So they are considered therefore as short-term assets. They are one of the backbones of the sales generation of the entity, and thus it must be managed so that they are eventually translated into cash inflows. Okay, so because accounts receivable, if it will be left uncollected for a longer period of time, then the capital of the enterprise will be tied up to it. And uh, especially if the accounts receivable are of a large amount, so this will become a problem later on that will lead to losses, okay, which uh, is from the non-collection or delinquency of payments of our customers. So a company that fail to efficiently convert the receivable into cash will be in a poor liquidity position. So, of course, it will affect its working capital and it will face unpleasant operational difficulties because, again, the capital is tied up to the accounts receivable. When in fact, if it was collected, the money or the cash can be used to finance the day-to-day operations, to invest it, or to purchase other assets. Okay. So, why companies offer sales on credit? So, we've mentioned the reason why, okay, in our initial discussion for under this topic. So, basically, the majority of enterprises offer their clients the opportunity to purchase their goods and services on credit. Okay, what is the reason? So when designed appropriately, such an arrangement can be manually beneficial for both the firm and the clients because on the part of the firm, it will encourage more sales because the customers wanted to avail of the goods and services, but they are not able to afford it at the present time. So if we will extend or offer them credit, then they will be encouraged because the payment will be deferred. Okay, so this is on the part of the client and the firm. So it has both benefits if it will be handled efficiently. So companies can ramp up their sales in a given quarter, more inventories, and ensure stable operating cycle. So this should be managed very well. Okay, because again, we are talking about extending credit to our customers. So there are risks associated with it, such as non-payment and delinquency, okay, delayed payments, or difficulties of collecting the accounts receivable. So on the other hand, clients can access company inventories, okay, so as mentioned, and at the same time, they can defer the payments. So it will allow them to manage their cash flows as they deem is best for their own operational cycle. So we've mentioned this a while ago. These are the benefits on the part of the customers. Okay, so what about assessing credit worthiness and the risk? Okay, so of course, as mentioned, if you are to extend credit to your customers, before you allow them, you have to assess their credit worthiness and at the same time the risk associated with the credit. So prior to engaging in a sales on credit agreement with your client, so you should conduct an analysis, okay, of the client worthiness and their short-term liquidity. So you might assess as well their working capital or their assets if they um, are able also to pay in the short run, okay, the credit that you will be extending to them, or else you will have the difficulty later on when you collect those receivables. So you can have this data from the payment history if these are your regular customers, okay, from their financial statements, general economic conditions, okay, and the like. So these are the sources of information that you can use in assessing the credit worthiness of your customers. So particular attention is paid especially to the customer's liability, okay, their short-term, even their long-term liabilities, okay, which affects, okay, their ability to meet their obligations. So you will see there if they are able to pay for their liabilities on time. Okay. So furthermore, third parties can also furnish you with the data related to the credit risk analysis and report. Okay, so but you have to pay for them to do this. So they are typically consulted, and in some cases they are outsourced. So you can do this if you are a big business enterprise having a large number of customers with large accounts receivable balances. Okay, but if you are just small scale business, you can do this on your own. Okay. Another consideration for the accounts receivable management is designing sales and credit terms. Okay, so this is the features that you will include, okay, in your um, sales on credit. So depending on the assessment of the client's credit worthiness and credit risk profile, so the ensuing step entails extending the actual terms of sales on credit. So here, how many days should you extend the credit? Should you provide or give them discounts if they will pay before the credit period will start or end, and so on. Okay. So for example, the term 5, 10, and 30. So this is a sale on credit policy. So this means that you allow your client to pay the net purchases for 30 days after the billing uh, invoice date, or if they will pay within 10 days, they will get 5% discount. Okay, but after the 10th day, if they will pay on the 11th day until the 30th day, then there is no discount. They will have to pay for the full credit amount. Okay, so these are just an example. So the client is also, yeah, as mentioned. Okay, companies must critically balance the benefits of extending favorable terms to their clients, like offering longer period of um, terms, credit terms, with their cash flow needs and working capital requirements. So you have to also balance these things. Okay, you should not extend more than what you can take. Okay, that you should avoid the period or the term that will make you suffer in terms of financial um, or cash requirements for your daily operations. Okay, so while enticing the clients to a lengthy term, of course, it will increase revenues because there will be more clients who would want to avail of those credit terms because it's long, okay, longer. So this also means that receivables will be tied up longer as well, and your cash receipts will be delayed. So this will become a problem later on. So moreover, the risk of receivables becoming uncollectible will increase as the longer they are outstanding. Okay. Okay, what about our collection process? Okay, in this case, the payment collections process is simple. Okay, using the respective, or you can use to facilitate the collection through our banks. In this case, the customers will send their payments to meet their obligations and sales terms, may it be online banking or through deposits. Okay. So another is you could also have your own accounts receivable department that will be responsible for keeping all of your communications, documentation, bookkeeping, and other matters concerning collecting the receivables. Okay, so upon receiving the payments, so it should be accounted for, it should be recorded, whereby your accounts receivable will be reduced. So we credit it because its normal balance is debit. Okay, and we will debit the cash that we received from the collection. So simple um, recording of the collection of our accounts receivable. Okay, what about if we have delinquent accounts? Okay, just like what we have mentioned before. So in the event of non-payment, so the use of collection agencies or the company's own accounts receivable department can be effective in recuperating all or a portion of the bad debt. So they should have the mechanism, okay, on what to do in case there are delinquent accounts. When we say delinquent accounts, these are the delayed or customers who are not paying on time. Okay, so always uh, we should always remind them, okay, of their balances. So most companies create a specific account to deal with these delinquent accounts. So normally they set up allowances for doubtful accounts or bad debts accounts. Okay, so these are contra asset account of your accounts receivable because it has the effect of reducing your AR balance. Okay, but there are cases where in the longer period of time, there are cases where we can recover those accounts if the customer will pay later on. So all we have to do is just to reverse this one. Okay. So there are also accounting procedures that are appropriate, okay, for the recovery of our doubtful or bad debt accounts. Okay. So in relation to this also, by examining the historical delinquent accounts and the patterns of from the history, so management usually forecast the bad debt. So this is where we get the percentage rate of bad debt, or uh, allowance for doubtful account um, portion, okay, from your accounts receivable. So, or it could also be a percentage from the sales. So it will take that into consideration when you should, or the entity should take that into consideration when managing their sales and receivables. Okay, so those are the accounts receivable management. So in the next video lecture, we will still have to discuss about the performance evaluation of our AR.